Okay, I'll kick off. Well, almost got used to talking to screens, but it's never quite the same. It would have been lovely to have been with you all, but life wasn't going to be like that this year. It's all got very complicated. So thank you very much for the invitation to speak at the symposium. And thank you also for choosing 3 topics that are very dear to my heart and that I'm really comfortable to share with you some of the research that we've done over a number of years now. And I'll also flag some new research that's about to be released as well in this area. So yeah, my 3 key themes and the conversation is going to go around what that risk or uncertainty is all about. We'll touch on strategic management, also bring in some work around resilience that very much connects risk with strategy. Talk about metrics that matter, and I just noticed in the chat session that you've had some conversation around metrics already this morning, so that's great. And what are some of the key risk management strategies that we've observed in our research? So I think the first thing around risk, and I always think, when I'm talking to Australian audience, it's a little bit like, teaching grandmother to suck eggs. I mean, you guys know about uncertainty. You live in far more volatile environmental climates anyway than us in New Zealand. And therefore, a lot of the really good risk literature and academic work has actually started off in Australia. There's some really good stuff there that's been coming out over the years. So the only certainty, as we know in life, what is it, death and taxes, but it is uncertainty. We know that things will be uncertain. On the right, you can see the graph of milk prices, very benign for a very long time and quite low, and then suddenly, bang, off we went onto a roller coaster that really hasn't stopped. The other thing that I think is really important to understand around risk, and here I put my business hat on, not my academic hat, because too often when I talk, especially to government bureaucrats or people who are talking about risk that happens to other people, not to them, they see it as a negative. And they're always talking about the threats, the threat of this and the threat of that, and how, we've got to find ways to help farmers manage all these threats, all the things that are going to get thrown at them. When I talk to farmers or people in business, they look at that same environment and say there's some opportunities there. I mean, and that's what entrepreneurs do. They find the upside risk when others might only look at the downside risk. So that's been quite a challenge to bring into the academic area, where most of the literature is around downside risk. And so our research for a number of years now has very much focused on both the up and the down, and I'll unravel that as we go. The other that's important is also to understand how people individually perceive risk, and then also what their attitude to risk is, because both of those could have an impact on what you then do about it. So we explored that in the research. But generally, I presume there's some farmers in the audience, so I have sort of written this in that way. It's your capacity as a manager to interpret that risk and respond to both external and internal information that will in turn determine the extent of the advantage or disadvantage that's eventually realized. So you do have a role to play, and it's around that interpretation and response. So there's this term, VUCA, the volatility, uncertainty, complexity, ambiguity. And it really sort of picks up the world that we've been in for some time. But I think one thing I just want to point out that I think is a useful one in terms of understanding the global environment, and certainly in dairy, is how different it is for us in New Zealand anyway. And I know for certainly down in Victoria it would be similar, where we really do are much more focused on growing grass and forages, whereas for the rest of the world it's what they call the cropping conundrum. So what is the milk price with respect to the feed price, and should I either decrease or increase my milk production as a result? And it creates huge, it does exacerbate the market volatility that's already there. It's a very lightly traded market. The global dairy market, only about 9% actually crosses borders. So, it's a thin market and can be very volatile. But if you have a look at these graphs, just, I know they're a bit blurry, but the third block in. So at this point here, the EU, milk price, feed price was not in a good place. So these graphs are all about percentage change in production per year. So in that period, the EU production fell. If I go to the US and Canada, exactly the same reduction happened at that period. Latin America, exactly the same, slightly different because of course the Southern Hemisphere, so you've got a slight change there. But those are and then even in the sort of post Iron Curtain type countries, a slight delay there, but it still happened. So there was this reduction. So everywhere we had this reduction in production because of unfavorable milk price feed price ratio. Either the milk price was low and feed price was high, or the milk price was high but feed price was even higher. I mean, either way, the ratio is not good. Then we go across to Oceania, exactly the same time period, and we were just pumping milk like there was no tomorrow. And the reason why is because it was raining. We had the rain, we had the grass, we would produce regardless. And so we are asymmetrical in many, or atypical of what is actually happening in the global supply and demand balance. And therefore, it's something that needs to be understood when people make some sweeping statements about what's going on in the world. The other thing is that, this upside downside, I've tried to capture this with some photographs. So the upside is up here on the right-hand side, amazingly lush grass, animals up to their knees in grass, amazing fodder wheat being grown. And then you have, below that, floods, you've got droughts. This bottom left-hand corner is a favourite of mine. This is when half of our woolshed blew away on the farm that I live on. And it took 18 months to persuade the insurance company that actually, no, we didn't want to rebuild half a woolshed. We actually wanted to replace the whole thing. Luckily, we had another woolshed somewhere we could use in the meantime. But so yeah, all the what we know what uncertainty throws at us in farming. This is an example of the sort of the negative, the upside and downside risk that I was talking about before. So if you're looking at something like finance, attracting financing terms is the potential, working with your financier. The threat is that financier might say we're not going to fund you at all. In business relationships, the upside is accessing those future opportunities because you've developed those relationships. You've become a key supplier. You're someone who they really want to deal with. And then the downside, the threat is that you're not a key account and therefore you become less relevant. So it's always, is the glass half full, is the glass half empty, is there upside, is there downside risk, do I understand it, and what can I do about it in my business? So we've surveyed the New Zealand dairy farmers since, I think the very first surveys actually were done by a colleague of mine, Sandra Martin, down at Lincoln, and then we've sort of picked it up from there. So from 96 onwards, every 5 or 6 years they've been surveyed, and this both in terms of their perception of risk and the risk management strategies that they've put in place. So this was a relatively recent one on perceptions of risk, and you can see this is the downside risk. So these are the threats. What did they find? Well, input prices and availability was becoming more and more of a threat, especially as farms were more reliant on purchasing inputs, and those inputs could also include labour. Interestingly, the red one, local body laws and regulations, and the purple one, government laws and policies, which are the national ones. These were almost insignificant back in 96. They're now the biggest coming through. Jointly put those two together, you've probably got the biggest block of threat coming through. Global economic and political situation with 96% of our product exporters. That's no surprise that that's there as a potential threat. If things collapse offshore, then markets don't look so good. And then it gets to things like interest rates, product prices, climate, competitors, etc. So what did those same farmers think their upside risks were? Well, interestingly, yes, on the threats, they said what's happening in the world and economic crises or whatever else could be a threat, but so also is global supply and demand and opportunity. So this is the upside risk, and that was by far the biggest they could see. And this is backed up, I don't know how many different places, forums I connect to where, that's demand for what we produce just keeps on going. And through COVID, it got even stronger. This is a nutrient dense food, it's good for you, and people just want more of it. So that was the farmers' perceived upside risk, and that certainly has played out, and they saw connected to that strong product prices. The bit that I found really fascinating, because this has come through in a number of surveys that we've done since as well, is that this belief that technology, the third one, is where the opportunities lie. And I love that, because what that's telling us is that for our farmers, they have a belief, even if it's something, even something like climate change, there is technology that can be found. There's a strong belief that technology will master whatever the challenge is that comes through, and they've got a track record of that. The technology has helped farming for many years, and the belief here is that it will continue to. And tied very closely to that is this one: skills and knowledge of those associated with the business. So this is a strong belief that not only those that work in the business, but those connected to the business will provide opportunities for the future. So this is the talent base, this is the skill set, this is the capability that will take this business forward. Connected to that is reputation and image, and the importance of that, and the fact that people are saying, I can use this. They weren't seeing that as a negative, they're saying this is something I can use for the future. And then we've got pasture and crop health, land values, and other things coming through. But interestingly, those were the key perceptions of the upside risk. So when we deal with an individual farmer, we map it, and we put onto this chart what those risks are, where they sit. And then when we're talking to them around, well, where are we going in terms of strategy, it's very much, well, okay, is it in your area of attention? So really anything that the business should now be focusing on is the things that they say have a high positive impact or a high negative impact. So they're sitting in this area and are most likely to happen. So they're at the top of this. And so that's what this area of attention captures. So number one, for example, very high negative impact, very high certainty of happening. For this particular farmer, there was climate variation, government laws, and local body laws. So if their strategic plan or their business planning going forward doesn't address that threat, then they are ignoring something that they've already identified as being a key problem. On the positive side, very high impact, highly likely to happen for this farmer was operations and business practices. So that was a relatively internal thing, but something that they believed there was huge potential to do something with, and capturing this global demand for farm products. So position your business so that you can. Someone said to me the other day, well, it's all about risk, luck. You're just so lucky this year because everything's aligning. Because I was saying, last year we had climate and commodity prices and currency, everything was aligning. And he said, gosh, that's lucky. And I said, nothing to do with luck. You actually position your business to capture. It is lucky when you can, but it's not just luck that drives your ability to do so. So this is about recognizing what matters, what's going to have a big impact, high, positive or negative, is it likely to happen, and then making sure you gear your business towards addressing this. And you ignore these things sitting out here. So too often you'll have people having lengthy discussions about stuff that actually is not, they haven't recognized as a negative or a positive impact, and it's highly unlikely to happen, and it just becomes a wasted conversation. So having said we've got all this uncertainty going on, and yes, it's upside and downside risk. I love this quote. This is from Michael Bolge, who's a professor at Purdue University, and he's been sort of my guru forever, I think. But this quote, I think, really helps us as business people understand what this is really all about. Because it says strategic uncertainty is the sensitivity of the company's value, so which obviously reflects how well it's doing, to inappropriate strategic choices. In other words, you as the manager have made the wrong choice. Number one. Secondly, ineffective strategy implementation. You made the right choice, but you've actually mucked up. You haven't delivered. And then thirdly, and lastly, the uncertainties in the business climate. And it's the order of those three things that I think is so important, because those uncertainties are real. We know they're there, but it's actually what we do about them and how we implement what we decide to do about them that actually will determine how we progress. And so this segues into the session around strategy, but just remember, so often people will just, they love to blame. There's this, I can't get this done because, the government's done this, or Huey's done that, or, the new staff members just done such and such, and blame, but at the end of the day, it's look in the mirror, have I actually got my strategies right? And am I effectively implementing it? So let's think about what we mean by strategy. So when I talk about strategy, I'm talking about the right-hand side of this table. It's about leadership. It's value-based leadership. I'll go into that in more detail. So I'm not talking about the technical stuff, the day-to-day, the operational of how things can be done. This is really important, the technical. But actually, if someone mucks up on something today, you can normally sort it out by tomorrow. This is the shorter-term stuff. The tactical stuff is within a season. Someone mucks up in a season, well, yeah, you end up at the end of the year not where you hoped you would be, financially or production-wise or environmentally-wise or anything else. But you can probably pick up and set it right again within the next couple of years. Someone mucks up in this space on the right-hand side, then you've probably lost your farm, or you've doubled the size of your farm if it's the opposite. So this has by far the biggest impact, and this is where the strategy bit's all about, and it's about positive change. So I could take your farm to some farms who I would say are not strategic at all. They've been incredibly good technically, amazingly good tactically, but they've actually never made a positive change in terms of they haven't changed their business from one point to another. They've consistently delivered what they've always done. I always say, that you hear the story of someone who marries the girl next door or the boys next door and doubles the size of their farm. For some, that might be the only strategic move they make in their whole life. And that probably sets them up for life. It takes about 20 years to lose a farm. So, that's pretty good strategy. But, real strategic management is doing this on a much more regular basis and taking that business forward, positive change. The actual process of strategy, the only reason I'm putting this up here, and I don't want to delve into sort of 101 strategy, but there's some key things here about strategy, is that it is about value creation. You're creating value for the customers, the employees, and the owners. So that's a key. If all three are having value created, then you're actually on to something. It's really delivering. It does require a vision, and I'll talk about that shortly. It does require you to craft strategy. So this is where you develop, your strategic choices, and then it requires you to implement that strategy, then to say, well, how did it go, and so on with those feedback loops. So if we're looking at that vision, this is another quote. I was very fortunate today to go to a international company directors course at INSEAD over in France in the days when we could travel. And in the course there, unlike a lot of the American courses, this course was very focused on family businesses, because many of the large European companies are actually still family-owned businesses. So we had quite a lot of discussion, and that actually connected really well with my interest in cooperatives, which are, if you like, very large extended collectives, as some of these large family businesses are. And in the research through all the businesses they've worked with there, they basically say this strong value creation, and we have that circle of creating value, corresponds to owners having a clear and strong longer-term vision for the firm that they own. So having that vision in place, making sure that that's absolutely part of taking that vision, that positive change is what that vision is actually identifying. So to have a vision, it's got to be a shared one. It's got to reflect the value set. We don't have time today, but I normally take an audience like this through a suite of questions around values and help them determine what their value set is. It must recognize cognitive biases. So often we latch onto information that confirms what we already believe. The one I most detest is the hindsight, wisdom in hindsight, or only looking for hindsight wisdom to actually factor forward, which just makes total nonsense. So, all of the tunnel vision, we've seen it all, I'm sure, in the audience. And so being sure that we are aware of these cognitive biases that do prevent us from seeing the future, that will stop us from getting a good vision. So a good vision has to be imaginable, feasible, as well as measurable, important, stretching, exciting. It has to be something that people say yes. That's what I get out of it. That's what matters. And it's all about value-focused strategic leadership. So just an example, just quickly talk about those value categories that I've talked about. Said if we'd been in a bigger group, had a longer time, we could have gone through into some of these, but it's important to recognize that the values within your senior leadership team or ownership team, let's say it's the family, there may be 3 or 4 people in that sort of at that family decision-making level. Those values will differ from person to person, and it's recognizing those differences as well as recognizing the cognitive biases that are important in trying to pull a vision together. So there'll be some in the group where it's all about, obtaining money, there's money, security, assets, all the rest of it. Others where it'll be very much around the interpersonal side of it, the social side, communities, very strong for these people, making sure that, these relationships are enduring within the family and beyond. The other group, this is farming as value as an activity in its own right. This is very typical of New Zealand farmers. This would rank the highest in pretty much all the surveys that I've done with groups. And this is about, pride and, well, it's sort of, yeah, I do the work because actually I just like doing the work. And it's almost, I used to joke that, for my husband for years, he couldn't be caught inside through the day by anybody because that meant he wasn't working. Even if he was doing very important stuff in the office and sorting out things, that wasn't deemed to be work. Real work was the hard physical work, and that's what was valued. And then the last one is expressive. That lifestyle one is probably slightly misnamed. I remade it. It was originally called intrinsic values, which I think is probably more correct, and I need to put it back to its original name. The expressive values is more about the means of self-expression, personal fulfillment, the pride of being a farmer, the pride in terms of what you do, and the fact that you can be creative and that you can actually really stand up for something that you believe in so strongly. So these 4 are interchangeable. I find these scattered right through farming communities. No one is right ever. It is absolutely what people believe in. What I do find very commonly is that the top one, the business values, is the lowest ranked in pretty much every group that I work with. It's there, and basically what that says is, yes, profit is important, but it's a means to an end, and the end tends to be fall more into some of the other sets. So this is a vision statement for a family business not far from where I live. We worked with a few years back, and they pick up a lot of things in this statement. So for them, it's to pursue excellence and growth. That's fine, and that's, if you like, that's your business side of it coming through. But in sustainable agriculture, so very strong on making sure that there's the environmental and the social bit very much in balance. They want diversification, and so they had quite a diversified business. This was a 7th, 8th generation farm, so succession is right up there in the vision statements. It's part of what they stand for, what they do, and this is about passing the baton. It's not cashing in what we've got now for this generation. And the last one was neat, continuously improving the standard of living for all stakeholders in the business. So they want not just them to be living well, they want everyone they do business with to be doing well. And so that's their sort of reason for getting out of bed in the morning. So moving on to resilience, and I bring some of the resilience literature in here because I think it's useful for just pulling together the strategy with the uncertainty. And I'm going to have to speed up, I just looked at my phone. So this resilience isn't just about a farm, it's very much about the people that connect to it. There's 3 types of resilience, and it all depends on how big the shock is, whether you're just bouncing, buffer capacities bounce without breaking, adaptive is changing, transforming is fundamentally changing because what you have is untenable. We looked at buffer capacity, this bounce without breaking one. We looked at dairy-based metrics to work out, well, what tells us the farms that best capture upside risk and those that best mitigate the downside risk. Could we quantify the characteristics of the farms that actually are resilient or perform best over time? Recognizing the resilience is an emerging property. You can't actually, you don't know you've been resilient till you've got there. So it does make it hard to measure. What we found was that none of the farmers who best captured upside risk in the good years were in the group who best mitigated downside risk in the bad years. And so that was interesting. The strategies they had, they either had strategies that were really good at capturing the good when it came and not so good when the bad came, or vice versa. But in both cases, the one metric that was high for both groups was this one called operating profit margin. I'll come back to that one shortly. The metrics are important. In New Zealand, we've had an obsession on operating profit per hectare forever. And if we rank and select on that, we are by definition championing those people who are more intensifying. Because as this graph shows, the higher your stocking rates of these farms, these 5 groups, the stocking rate is higher per group. That's the black line. So stocking rate goes up, the kilograms of milk solid go up per hectare, and the operating profit per hectare go up accordingly. Highly correlated, and that's what happens. But if you then look at the resources each of those 5 groups use, more cows, more machinery, more infrastructure as you have higher stocking rate, you then find that actually there was no statistical difference between the systems if you looked at their return on assets, which is your operating profit divided by all those assets. So if you've got more assets, your operating profit might be high, but actually what you're doing is netting off the same return on assets and a very similar cost of production. And that does vary a bit from year to year and depends on what's happening with milk price, because if you are more intense, you can chase the milk price more, but this is over quite a number of years of data. So be wary about metrics. In terms of buffer capacity for both dairy and sheep beef farms, we've looked at a number of data sets, and time and again, this emergent property, this metric that did distinguish those farms that were more resilient compared with others, and again, always remember you don't see this to the end of the year, were those who got the best operating profit margin. So they maximized their income and minimized their costs at the same time. And here's an example, the high index group's operating profit margin at 40, that means 40 cents in every dollar is still there at the end of the year versus 22 for the lower index. And then, yes, operating expenses, there's a lot of other differences in there as well, but essentially it's almost double. So that's a lot more money still in your back pocket if you can really focus on managing those operating expenses. Expenses here at 383 per kg versus 489, so $1 less. And they were making more in terms of their production was higher, and they were actually able to achieve that operating profit margin. So just quickly moving on to the risk management strategies, just realizing what we're told, so I'm running out of time. Just wanted to dwell, again, these are the surveys that we've had. The managing debt has come through as the #1 strategy over the years. Interestingly, it's replaced what used to be a strategy called keeping debt low. And we've just had someone finish a PhD where he focused absolutely on what they meant by managing debt. And there's some really interesting methods by which farmers do manage debt to the point where they can actually quite comfortably take on more. And that's really what managing debt's about. It's about knowing how to manage it. And the other one's planning of capital spending, and is very much a cash flow thing. In other words, I will buy the capital when I need to. So this was a liquidity strategy. So is the managing debt, because nearly 70% of the farmers had interest-only loans, which meant they also only paid back the debt when they could. So that was a liquidity thing. Many of these other strategies were actually around planning, having planning steps, having a purpose which links to a vision, doing SWOT analysis, having long-term flexibility. So that very much that sort of strategic approach came through as strongly in the strategies that the farmers were adopting. And just very quickly, I haven't been flagged yet to stop, so I'll finish for the time, at a question time. We did mention earlier on, I said there's perception of risk, which we talked about, management of risk, we talked about, and attitude to risk. We asked farmers to we grouped them by their answers to questions around their ability to manage risk over time, their propensity to playing it safe, those sorts of things. And we ended up with 3 groups. Risk takers, risk neutral and risk averse. The risk takers had they were more of the glass half full people. All groups ranked the managing debt and planning capital spending high, which is what your pie chart on the earlier graph would have shown you. The risk takers said that they weren't into keeping debt low or not producing to full capacity, whereas the risk neutral group said that they actually did focus on keeping debt low as well as managing debt. And so if I just show you the results, interestingly, the risk neutral group, which is the middle group, which is really the strongest in terms of total return on equity, right up there with good results. They actually had a debt to asset ratio almost exactly the same as the people who said that these people, remember, said they kept debt low. These people said they didn't keep the debt low. So be wary when you're talking with people. For one person, 45% is actually managing debt low, and for the other, it wasn't. And so these guys actually had a very strong ability to manage the debt, because if you look at their interest to rent as a percentage, they were only at 21% or 22 versus 25 for these people. So they managed their debt by making sure their income was such that the debt servicing capacity was kept under control. The last thing we looked at was the next step in resilience, which is with the adaptive capacity. This is the people bit, and these were the 5 things that came through as the key attributes of the resilient farmers: willingness to change, self-efficacy, locus of control, the social sense making, and the strategic thinking. And I'll just dwell on this briefly, because for what we found in the work that came through, the important thing here, again, we'll come back to strategy, but it's not just about strategic planning. Some of you will have been on courses and learned how to do a business plan or a strategic plan. That doesn't make you a strategist. What makes you a strategist is actually the strategic thinking. This is the time spent looking outside the farm, thinking about the big issues, working it through, coming up with ideas, and then the planning kicks in after that. And so interestingly, it was the strategic thinking that was dominant in terms of whether somebody was a resilient farmer or not. Similarly, willingness to change, and that it has to be key, because remember, this was about changing your system, adapting. Self-efficacy was a key part, because that was about actually understanding or being truthful about what you didn't know, and where help would come in to assist. And so often, some of the farmers I've worked with, they had a team wrapped around them of very capable people who filled in the gaps, so everyone was aware of the role they played, and then that sort of helped the business going forward. Social sense making, this is something that farmers do so well, and this is about discussion, debate with us. So you don't sit by yourself, think, oh, I've got to sort this problem out. It's just so huge. You actually get together with others, and you work through, and you determine how can we crack this? What are the things we need to know? And collectively, you build that knowledge, and that social sense making is very powerful and very, very useful in terms of coming up with solutions. And then in the last one, locus of control is one that is my favorite bugbear in a way, because I always say to my students, so tell me on farms you worked on, if somebody has done something wrong, how often is it that, or something goes wrong, how often is it that somebody is blamed? And nearly all of them will put their hand up that, this is what they've observed working on farms. And so the blaming of others is what they call an external locus of control. And the external locus of control is not helpful if you want to be a resilient farmer. An internal locus of control is this one, as it says, motivation to solve problems. There's a great example in the Good to Great book. They talk about, you know, someone, if something goes wrong, it's the manager who looks in the mirror and says, what did I do wrong? What is it that I could have done differently? How can we learn from this to make sure that next time, because there'll always be a next time, there are always more droughts and whatever, next time I do it differently. So that really strong focus on learning. And so learning comes through, whether it's locus of control, whether it's in the social sense making, whether it's up here, you need to learn to, you know, develop that confidence to be willing to change. And so those factors were all the ones that fed in our research into what defined a resilient farm. So wrapping all that up, and I'm sorry if I've rattled through it a little bit. We know the future is unknown. That's just the reality. We need to be really clear about what we understand that future to be as much as we can. We see it both as in its upside and its downside perspective. We need to be really clear that our businesses are run from a value-focused strategic leadership perspective way. That's the way we should be running our businesses. Being really clear about what our values are, what our differences are, and how we can pull that together in terms of a shared vision for the future. And I didn't mention this, we have tried to see whether there's a difference between the perception of risks and, say, risk management. You know, with someone who is more of a glass half empty person adopt different strategies to someone who's more of a glass half full. We didn't find that. In fact, there's not many research projects I've seen that actually do find that. So that they're not necessarily correlated. The risk is the same for both. But there is a correlation between attitude to risk, you know, whether they believe they have the confidence in it or they risk averse or not. That can happen across the board. But it's that implementation that makes, going back to Michael Bolge's quote, that really determines whether you're successful or not. Misleading metrics abound. Just be careful with how you're measuring success. Make sure it really is connected to where you're wanting to take your business. I've spent a life looking at metrics, and far too often, I've seen people adopt a metric and change their business according to that metric, and it's quite contrary to where they actually want to be or where they're taking the business. And then lastly, you know, your ability to cope will rely on your resilience. So as a farm owner, manager, you know, it is about having agility, having those networking skills so you can do the social sense making, absolutely learning every minute of the day, your attitude and your awareness of the world beyond the farm gate, which is just so important to strategy. So I will stop at that point.